If you're a long-term investor, you recognize that you're investing in the business behind the stock that you're buying. And as a result, the operating results of the business is what ultimately is going to determine your rate of return. When you look at a company like Pitney Bowes and plot their earnings, you can see earnings growth coming into 2008, which was the recession. And then you saw earnings collapse over all these years. So when you add weekly closing stock prices, you see that stock prices track that earning results. And obviously, Pitney Bowes has been a dinosaur since. But you can also look at dividends. When the company was growing, they were able to pay an increasing dividend every year, and they even did it a couple of years after earnings started to falter. But then as earnings continued to collapse, so did the dividend till they eventually got to where the dividend payment was so low. But you can also look at how the market has valued that. Because of the weak performance, the market has historically applied a low valuation of under 15 times earnings, which is the standard. It's only priced this company at about 11 times earnings. In contrast, if you look at a company like the one we're featuring in this video, like Owens Corning, it would be important to understand that this company has grown earnings at over 14.5%. Now, it's been moderately cyclical at times. You can see that, and it's expected to have a down year in 2023, followed by a slight improvement before earnings begin to grow dramatically again in 2025. So when you put stock prices on this graph, weekly closing stock prices on this graph, you see that the stock price has tracked earnings. But also, let me show you something else that I think is very important. If I use my scroll bar here and kind of bring this into a period where the stock started at fair valuation, which is defined by this orange line, that's the 15 normal PE ratio, or an earnings yield of 6.6%, you can see that with volatility, notwithstanding, ultimately the stock price went to where the earnings did. And when the stock got very inexpensive, the company eventually reverted to the mean and went back to a justified valuation. But it also did that same thing happen when the stock was overvalued. So now when you look at Owens Corning today and see that the growth has even accelerated and recognize that the market is applying a low valuation, it would be logical to assume that this company might be a great investment going forward. Now, when you look at the normal PE ratio, because of some of the cyclicality, this stock has traded at about a 15 PE ratio historically over these last few years. But long term, it's even traded at a higher value. Now, adjusting the time frames is important because every time you adjust the time frame, note that your earnings growth rate changes. So if I look at Owens Corning going forward, it's expected to have about an average of about an 18.5% growth from 2018 forward. And since 2018, we've really had a very low valuation on this stock. However, looking forward, the company's trading at a significant margin of safety, significantly below even a low valuation like the 11.88. If I was to calculate what the potential performance was, you would see that we have an average expectation of about 26% a year if it just moved to a 12 PE, which is currently trading at an 8 PE. If it moved to a 15 PE, which is where I think this stock belongs, then your rate of return would average over 47% over the next couple of years. So looking at this stock practically, I want you to realize that it's the business that ultimately generated the rate of return. And when you get periods of overvaluation or undervaluation, as I've previously said, those become either opportunities or levels of higher than normal risk. Because the real point is here, when I use this scroll bar again, if I go into this and show what Pitney Bowes looked like when it was fairly valued and ended fairly valued, we had an 11.88% growth rate. If I look at performance history, we see that the performance was almost perfectly aligned with the company's earnings growth rate. Earnings in the long run determine market price and determine the investment returns that you're going to get. So when you see an opportunity to buy a bargain like Owens Corning at such a low valuation, then this should, give you an opportunity to look at, taking a long-term position in this stock that has a very good dividend record. Let's also examine that. Now, one thing that I want to do before I do that I want to point out, if I go back to the historical Owens Corning graph, I want you to note that when I look at the dividend line here, this is the dividend each year with the payout ratio. That's the area. This is all the company's earnings. The company has a very low payout ratio, but it's offering you a 2% yield now. That's another margin of safety factor that I think you would add. So, the company has paid out these dividends. As you can see, it's a very small percentage of what they've earned. So the company's, got plenty of opportunity for growth, and it also has plenty of opportunity to give you a growing dividend income stream starting out at a 2% yield currently. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I'm kind of doing a second video this week because I've had several of you ask that I should cover Owens Corning, and I should look at it a little bit more in depth than I normally do on stock. So I'm going to kind of do that at a high level here today. What I want to do is I want to kind of really illustrate how I would go about looking at evaluating a stock like this. I would look at Owens Corning as a good dividend growth stock, although it has a short dividend history, but I'd also look at it as a great long-term opportunity to generate some real capital appreciation, and I consider it a very low-risk investment because of the fact that it's BBB rated, it's investment grade. Going back to the fast graph, it only has 39 or almost just under 40% debt. And, it's got a great history of cyclicality, which has obviously caused some short-term either opportunities or risk based on stock price volatility. But right now, the stock looks very, very inexpensive to me if you're a long-term investor. So let's go back into the fast graph here, and let's look at what I would do to research this stock further and deeper. Now, before I leave fast graphs, I do want to point out that I would go into the financials, and I would go into things like the fiscal fitness section of our financials. This is only available to premium subscribers. And I would look at things like, the free cash flow covering the dividend. And you can see here that the company generates more than ample free cash flow to cover the dividend. The dividend is the purple line here, and the free cash flow is the green line here. So, the point is we got plenty of free cash flow, and I would go through all of this. I would look at things like margins, what kind of margins the company generates, good margins and good net margins, although they did have a little bit of a margin issue in 2020. But I would go through the financials. I would also go into the financial statements of the company and, spend some time looking at the financial statement. And I would also go places like fund graphs. Okay. And what I like to do with fund graphs is go into the company and look for things like diluted shares outstanding. I want to see share buybacks and dividends. This company has been buying back stock, and they have been throwing off a lot of their cash for dividends here recently. They just announced a dividend a couple of days ago. It's the same dividend as past, but they also raised their dividend pretty much last year. So, you're looking at a lot of areas here. I would study this, and I would go through this, and I would look at all the factors that you would want to financially. But once you've done that, once you've kind of done that through fast graphs, you can also go to the external links here. And, I'm a subscriber to Zacks, so I would go into Zacks and I would go ahead and look at their analyst report. And here I would look at all the things. Now, I'm just going to summarize some of this for you. Number one is, as they say in the summary, Owens Corning is benefiting from strong pricing action, structural improvements, and strategic investments. Notably, adjusted EBIT and EBITDA in the third quarter rose 22% and 16%. Respectively. Now, you can also, by the way, look at that on your fast graph, because I think that's another feature that I didn't want to skim over. You can go in here and look at what happened to EBITDA and how the EBITDA increased in 2021. And we can also look at EBIT, as Zach suggested, and see how much EBIT has grown over the last couple of years, although it is expected to be down a little bit in the next couple of years based on estimates, but those are only estimates. You can also go here and look at things like sales. That's very important. And sales have been very strong the last couple of years, but they're expected to flatten. And again, that's not something unusual for a company like this. But anyway, I'm going to go back through the report now. A couple of things that are, just some overviews. First of all, Owens Corning is the world leader in building material systems and composite solutions. I'm getting this from the Zacks report here. Okay. And, I would read this carefully. I've already read it because I'm deep into researching this stock, although I'm not finished yet. But it's a world leader in building material systems and composite solutions. And since its inception in 1938, The company has evolved, according to Zacks, into a market-leading innovator of glass fiber technology. Its products include glass fiber that is used to support composite materials for everything from transportation, electronics, marine infrastructure, wind energy, and other high-performance markets. The composite segment accounts for about 27.5% of their business in 2021, but they also have an insulation segment, which accounted for 37.5% of their business, and they have a roofing segment. Now, I would, basically go through here and look at all this. The company has also made numerous acquisitions, which are listed here in the Zacks report. If you're a subscriber to Zacks, you can read them, but they have always used acquisitions to increase their product line and also grow their business. And through the third quarter of 2022, the company has already launched 46 new or refreshed products across global businesses, according to, Zacks. So I would, go into the external links and do that. Now, other external links I can go into things like Yahoo Finance, and I can compare estimates that we might see. And again, the stock's down 1% today, roughly, which is attractive. We can look at what the growth potential is for the next 5 years, according to Yahoo, and what they expect earnings to be. And you can see they expect a down year as well. But again, I can corroborate that on the fast graph and, see similar numbers on fast graphs, the 1019 for this year, followed by 1055, followed by 17. But I can also look at long-term growth. The first FactSet analysts that we subscribe to, which are only two given a long-term growth, say 6.5%. On the Reuters analysts that, report to Yahoo, they're looking at 8%. So 6 to 8% would probably be a good number. And looking at that, putting a 15 PE, that gives me a very conservative 15% plus reasonable rate of return going forward. So I'm using the tool here, the Fast Graph Research tool, to basically evaluate this stock. And what I see very clearly, just like when I showed you Pitney Bowes in the beginning of this video, where Pitney Bowes' earnings were collapsing and the stock price followed it, I've shown you here that the earnings of, a company like Owens Corning are growing. And when you find periods where the valuations are low, you get that inevitable opportunity to see a reversion to the mean. Now, we're already seeing some of that appearing or starting to manifest looking at Owens Corning. But what a great time in the market that is still, reasonably overvalued to, take a look at a company like Owens Corning. But, I want you to understand this relationship. And I get a lot of comments that suggest people don't. When I look at a stock like Conagra, for example, which I consider reasonably valued today, but I want you to note this stock has only grown at 4% a year. Okay, so if I look at the stock's performance long-term historically, I get about that 4 or 5% rate of return, less than the market, because my rate of return is ultimately driven by the growth rate of earnings. And so similarly, if I'm looking at a company like Owens Corning, which, I'm really featuring in this video, when I look at much faster growth rates, 14.5% long-term, and interestingly enough, as I shorten this, it goes up to 20%. And I shorten it even more, and I'm still looking at 19.5% or so. This company's been growing, but it is expected to have a little lull. So this would be a great time for a long-term investor to be building a position in this stock with what I would consider to be minimal downside risk, as long as earnings manifest as they're being shown. Now, some other features that I would go through with the tool, I would look at operating cash flow covering the dividend. As I pointed out earlier, they've only been paying the dividend since 2014, but the operating cash flow, I'm going to take price and the normal PE off the graph here because I want you to understand this clearly. This is the amount of cash flow that they generate. Their operating cash flow payout is single digits, less than 10%. So they've got plenty of cash flow to pay the dividend. They've got relatively low debt of only, just under 40%. They're a BBB rated company. I just see so many, things about this company that I really like as I look at it. If I'm looking to get a total return, a 2% dividend yield isn't bad. And that's, an opportunity you're getting to get a little higher yield because of the company's low valuation. Similarly, if I go through free cash flow, as I showed you earlier, free cash flow, since the company's been paying a dividend, has been more than ample to pay the dividend as well. And they're only, just barely giving double-digit payout ratios on free cash flow. So we're looking at a stock here that has an extremely well-covered dividend. I think it's also important to recognize that the company has grown their dividend at a very substantial rate. If I go back into these external links and go into a website like Seeking Alpha, I do want you to note that they just recently declared the 52-cent dividend, which was in line, but on December 2nd, the company lift its dividend by 50% to 52 cents a share, and they also boosted their share buyback program. So, as you go through this, you're starting to see what I consider to be a very, very attractive company that's trading at very attractive valuations relative to its operating history. The fact that this little bit of expectation of down earnings, which will still be, by the way, perhaps the second highest level of earnings that the company has ever generated, is what we're expecting to be a bad year in 2023, gives us a great opportunity to buy a very high quality company at a very, very low valuation. Anyway, you asked, so I thought I'd go ahead and give it to you. This has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I had several of you ask me to cover Corning, and I was really going to include it in the 5 dividend stocks that I did, the first of the week, but I tried to keep that video relatively simple. But anyway, here's a kind of a supplement for you. And I did want to go through this idea of companies like Pitney Bowes and Conagra, because I want to reemphasize this situation that as a value investor, you're really investing in the business behind the stock. You're not trading the stock or, chasing the market. And what you want to look at is pricing, what I would consider mispricing alternatives. If you see the stock being massively overpriced, you should take heed and recognize the risk. But if you see a stock like Owens Corning very, very low in valuation and very undervalued, then you want to take notice of that also and look at that as an opportunity possibly to invest in the stock. If you enjoyed this video, give me a like, ring the bell, subscribe to the channel if you don't already. And of course, look at FastGraphs. FastGraphs, as I showed you with the Pitney Bowes example, even the Conagra example, and of course, certainly the Owens Corning example, nothing shows you what the business behind the stock looks like better than what FastGraphs does. So you might want to take a look at subscribing. And by the way, we are working very hard on getting international stock, and we got some exciting news about that coming up that we'll be sharing with you here in forthcoming weeks. Thanks for watching. Hope everybody has a great weekend. And again, subscribe to FastGraphs, subscribe to the channel, and give me a like if you enjoyed this video. Thank you.